So if you had invested in these poor quality stocks, maybe they were good, but they have fallen, so you have lost. The chances are that 90%, that means 9 out of 10 chances are that you have lost money. How I can predict that your assets, your portfolio has not grown at the same pace, and what could be the reason? If you have invested in stocks, good quality stocks, if you have invested in good mutual funds, done SIPs, you are good. So let's get a little deeper in each of these three situations, and maybe you'll find out where you are, and then you can make the course correction. The market has grown from 100 to 224. The Nifty has grown from 100 to 224. It has given 124% returns. If your portfolio is not close to that, it's much lower, there is a problem. 17% growth year on year. Have you ever seen if your portfolio has grown by that percentage? Markets are at the peak. Markets have gone up. Sensex is at 85,000 and Nifty at 26,000. They have grown at a very fast pace in the last few years, the last 1 or 2 years. Has your portfolio also grown with the same pace? Has your portfolio grown at the same pace? Or it is going slow? Or it is going down? How is your portfolio faring? Which is more important? The markets may go up, the markets may break records, but what is more important is your wealth catching with the pace of the market? Are you gone ahead or are you still behind? And this is exactly what we'll see in today's video. There are a few things, a short video. I want you to understand how to grow your wealth, how to grow your portfolio, if not faster than the markets, at least keeping pace with the market. And that is very important. And what are those few important factors we'll see today? I'm Frankie Fernandez, a money and a marriage coach. I'm a certified financial planner, and I'm also a certified marriage coach. My goal is to help young families grow their wealth and also their relationships, which is both put together is your true wealth. If you are new to my channel, I encourage you to subscribe. I will keep posting videos that will help you grow your wealth, change your perspective about money, help you get rid of your bad habits, get rid of those things in your life which are pulling you down and pulling down your wealth and your relationships. And I will help you to look at it with a very new perspective, grow your wealth, grow your relationships, and leave a legacy of love and generosity. Okay, so let's get into today's video. And this is an interesting video. I'm sure it'll help you take a look at your own wealth with a very new perspective. So let's get into today's video. So first, let's take a look at how the markets have grown in the last 5 years. So if you look at BSE Sensex, it is 85,000 today. How much was it 1 year ago? 1 year ago, it was, last year, this time in 2023, it was 66,000 and it has grown by 30% almost. And in the last 5 years, in the last 5 years, it has grown by 118%. 2019, that is pre-COVID, it was 37,000. And today it is 85,000. Markets have gone down. They went up, went down, went up, again went down. And you see how the market has grown. And it has grown. That means if 100 at the beginning of 2019, September 2019, 100 has become 217, 218. 117 got added. 118 got added. And let's take a look at Nifty. So in the last 1 year, if you look at Nifty, it is given 32%, which means last year, this time, it was around 19,600. And today it is 26,000. 5 years ago, that is 2019, it was 11,264. And it has grown by 124%, which means 100 has grown into 224.4 in the last 5 years. In terms of compounded annualized growth rate, that is the CAGR, it is given roughly 17%. 17% growth year on year. Have you ever seen if your portfolio has grown by that percentage? And if it is not grown and it is way off the market has grown from 100 to 224. The Nifty has grown from 100 to 224. It is given 124% returns. If your portfolio is not close to that, it's much lower, there is a problem. So there are these three things that could have happened. Your individual portfolio is growing at a faster pace. You are keeping pace with the markets, which means you are more or less close to the market, or your individual portfolio is growing at a slower pace. And if this is happening, it's a cause of concern, because if you are in your 50s and 60s, it doesn't matter. It matters very little. But if you are in your 30s and even 40s, this matters. Personally, in my own life, in my early 40s, I realized this and made a change, made a shift, and that made a big difference. But if you're in your 30s and your 20s, it's the right age. So look at it carefully, look at your portfolio, why, whether it is growing or not growing. So let's get a little deeper in each of these three situations, and maybe you'll find out where you are, and then you can make the course correction. But if you're doing really great, then you can keep continuing. So what are these three things? What is the first thing? Your portfolio is growing at a faster pace. So what could be the reason? Number one, you have direct stocks. You have probably invested yourself in direct stocks, and they are good quality stocks. If you look at this report on equitymaster.com, uh, so in the last 5 years, the BSE Sensex has grown by 118%. It has grown, these are the absolute returns, and Nifty is 124. But you have got some of these good stocks like Adani Enterprises. From 152, it has gone up to 3,100. Tata Motors, from 127, it has gone up to 964. And so they have gone up much more than the Sensex or Nifty. So you've got Grasim, so you've got Tata Motors, LTI, Mindtree, M&M, Bharti Airtel, Apollo Hospital. If you look at each of them, they have gone up much, much higher. So this is 117 or 124. So you've got, which have, at least till Wipro, they have kept pace. So if you had invested in any of these stocks, then you have actually grown. So direct stocks, if you invested in good quality stocks yourself, if you had the knowledge, the information, and the timing, you probably have gained. Or else you have invested in some top performing mid cap or small cap stocks. Direct stocks, what I just showed you were the large cap. Probably you've invested in top performing mid cap or small cap stocks, which have done great. Or you have invested in mutual funds of these mid cap or small caps, which have given high returns. For example, so if you look at some of the funds, for example, the large cap funds have given 23, 26% compounded returns. So BSE and NSE have given roughly 17 to 18% compounded returns in the last 5 years. And if you see, these mutual funds have given more. Large and mid cap have given much more, like 26, 27%. Flexi caps also have given 28, ranging from 22 to 28%. But mid caps have given 34, 37%. And small caps, again, 37%. Just a quick disclaimer, I'm not recommending these funds. This is from Economic Times Wealth Edition, which is available with Economic Times on Mondays. It's a publicly available information. I'm not recommending these funds. I'm just sharing with you the returns. Please check with your investment advisor, your financial advisor, or mutual fund distributor to let you know what are the funds. So my goal is to just tell you how, if you had invested in these funds, your stocks or your portfolio has grown up at a much faster pace than the markets. And when I talk about the markets, I mean the large cap broad index, BSE Sensex and Nifty 50. Or third, you have an equity allocation as high as 100%, which means most of your investments, most of your portfolio, or 100% of your portfolio, that means your net worth, all your savings investments are in equities. So there are high chances that you have kept pace with the markets. Probably you've got the good stocks, good mutual funds, and so because of which your your portfolio is growing at a faster pace. If the market is growing at 17 or 18% CAGR, compounded annualized growth rate, you are growing at a faster 20-25%. Now, is this good? In many cases, mostly it is good, except for this. Except for this, but I've explained this in my other video on allocation, misallocation of portfolio, misallocation of assets, asset allocation. Please watch that. I've explained why you should not have 100%, because if the market falls, because if the market falls by 10-20%, which which doesn't happen often, but it can fall to 10, up to 10 or 15%, your portfolio will also fall that much. So asset allocation helps you maximizing returns but minimizing your risk. So it is never a good idea to have all into equities. Nevertheless, when we're talking about the portfolio growing at a faster pace, this could be one of the reasons. Well, the first two are good. Direct stocks, you were lucky, or you knew, you had knowledge, you had good information, so you invested in direct stocks and it worked for you. But if you had invested in a mutual fund managers take care. So there is a level of safety. So if I have to vote for the best, I vote for this. So if you continue in top performing large cap, mid cap, small cap funds, mutual funds, then I would say then you are doing well. So now let's go to the second option, the second category of investors. So if your portfolio is not growing at a faster pace than the market, probably it is growing at the same pace as the markets, which is good. So what could be the reason? Number one, you have a good asset allocation around 70 to 90% of your equities. Now again, this good asset allocation depends on your age, your financial goals, your risk profile. There are many things I've covered in my earlier video. Please watch it. So a good asset allocation. That means if 70% are in equities, the remaining 30% could be in fixed income, hybrid funds, fixed deposits, real estate, gold, or whatever. Number two, you may be having regular SIPs in large cap, mid cap, or small cap funds. So you can watch my other videos on choosing the right mutual fund and investing. Great wealth creation is boring. I've explained in detail how an SIP is way superior than lump sum investing or timing the market. So if you have done your regular SIPs in large cap, mid cap, or small cap funds, depending on your risk profile, depending on your age, then you would have kept pace with the markets. Because as I just shared, the markets have gone up, but those who do SIPs are able to actually beat the markets because of consistent investing. In a separate video, I'm going to talk about comparing SIPs with lump sum. I've already done that in my previous video. Wealth creation is boring. I will do a special video on and exactly show you the math behind this. Why an SIP? If the market has grown 18%, why your SIP will give you 20 to 25%, even 20 to 25%. So having SIPs is great. And finally, maybe you have a good mix of good quality stocks and mutual funds. And this is something that personally I do. I have most of my portfolio, equity portfolio, is into equity investments. If you look at my portfolio, my asset allocation is around 60 to 70% in equities. 30% it is into fixed income, hybrid, gold. I have not taken into account the house that I'm living in. That is also part of my asset, but I have not considered that. And in my equity portfolio, around 20% is in direct good quality stocks, large cap, mid cap, small caps, and the rest of it is into mutual funds, because I'm not an expert in picking up stocks. I just follow some of the good fund managers. I don't research on stocks. Until now, it has worked well. I've got some of the very good quality stocks, and most of my portfolio is into mutual funds. So, if you ask me, am I keeping pace with the markets? Yes, I am keeping pace with the market. So, my portfolio is growing at a pace with the markets because of I have a very good asset allocation. I used to do SIPs. Now, because of my irregular income, I don't do SIPs, but I do lump sum investing. And I have a mix of good quality stocks and mutual funds. So if you have these three, there is a high probability that you are keeping pace with the market. Now, just for the convenience sake, I'm just giving 3 points. There are many more points, but I have taken the three, probably the topmost reasons. Right now, so if you have a good asset allocation, if you have good equities, if you've invested in stocks, good quality stocks, if you've invested in good mutual funds, then SIPs, you are good. Now, the third category, what tells me how I can predict that your assets, your portfolio has not grown at the same pace, and what could be the reason? Let's look at the reasons. Number one, intraday trading, FNOs, trying to time the market, invest, withdraw, buy, sell. Then there is a high probability that you have lost money, and your investments, your portfolio is not growing at the same pace. It is probably going much down. You've lost a lot of your money because you wanted to time the market or you wanted to make money through trading. And this is not me. This is a report from SEBI, the markets. There is an article which tells what has happened. Let me read out to you that article. In Economic Times, there are these two articles. FNO traders lose nearly 2 lakh crore wealth in 3 years to March with just 7.2% profit rate. And if you look at this article, it says that retail traders lost 1.81 lakh crores in futures and options trading over 3 years to March 2024, with only 7.2% making a profit. According to SEBI, the number of retail traders nearly doubled, contributing significantly to lower total turnover. SEBI plans to tighten rules to curb risky speculation among retail investors. It means retail traders made a combined net loss of 1.8 lakh crore, and only 7.2 made a profit. So among individual traders, 91.9% incurred about 75,000 crore in net losses in the derivative segments. And who made profits? While individuals made losses in futures and options, foreign portfolio investors and proprietary traders earned profits. And the proportion of young traders below 30% of age trading in futures and options has increased significantly. And most of these individual trades belonged to low income groups earning less than 5 lakh annually. This is a very sad, very sad thing. And if you are one of this, you have lost a lot of your money. You need to change. You need to come out of this. Let's take a look at the other article. FNO addiction, 1.1 crore traders lost 1.8 lakh crore in 3 years. Similar news, FNO addiction. The top 3.5% of these traders faced even greater losses, averaging 28 lakh each. Only 7.2 of individual traders managed to make a profit. This is the same article, similar article. In a clear reflection of how households are losing money by betting on the high risk, high reward game of options trading, a SEBI study released on Monday found that 1.13 crore retail FNO traders incurred a combined net loss of 1.81 lakh crores in the last 3 financial years. And individual category traders made an average per person loss of 1.60 lakh over the period of 3 years. For the loss makers, the average loss was about 2 lakh per person, whereas for the profit makers, the average per person profit was 3 lakh per person. If you are an FNO trader or maybe doing intraday trading, trying to buy low, sell high, and all those things, the chances are that 90%, that means 9 out of 10, chances are that you have lost money. So naturally, your portfolio has come down. If you had just simply done an SIP or invested, stayed invested, used your money for that, you would have gained. So another reason could be you had poor quality stocks that have performed bad. Let me share with you this. Let me share with you some of those stocks that have done very bad. So again, the Sensex and Nifty have gone up, as you have just seen some time back. But there are these stocks. If you see here, Future Lifestyle 465 has become true. Then takes Solutions, Sadhav Engineering, Oriental Carbon, Bandhan Bank, a well-known bank, 527.8 has become 204. Yes Bank from 55 to 22. See the fall. GE Power 833 has become 384. SpiceJet from 126 to 62. Recently there was a news, so it has gone up again, probably at 100. Z Entertainment, RBL Bank, Pamela Enterprises, and so many of these. Bata India, IndusInd Bank from 1,500 to 1439. So if you had invested in these poor quality stocks, maybe they were good, but they have fallen. So you have lost. So that is the risk that you carry when you invest directly, because you have to keep a track of the stocks like a fund manager. And I've covered it in my previous videos. We are not fund managers, we are not experts. So we should not focus too much on direct investing. There is a huge risk. Finally, point number 3, bad asset allocation. That means your equity portfolio is very low. It's too low. I've mentioned this several times, and you would have heard many YouTube videos from several others that if you have a small portion of your portfolio into equities, your growth will be very, very slow. Now, if you realize all these three, the one thing that it all revolves around is equities. The right proportion of equities, right asset allocation, good mutual funds, good stocks. This is what will keep your portfolio going up. But if you do not have enough equities or have the wrong equities, you will be hit. Well, so what do we do about it? What is the best thing to do here? Let me share with you a quick few things to help you take an action, because this is very important that you take the right action. You probably have not gained in the last 5-10 years, but you can still change. You can still change the pace of your portfolio by making the right decisions. How to keep pace with the equity markets and grow your wealth? So number one, your portfolio must have the right asset allocation according to age, risk profile, and financial goals. When you're 30, you should have at least 60 to 90% into equities, depending on your risk profile and your financial goals, the time horizon. So watch my video, and you will get a very clear understanding on asset allocation. So I've clearly explained. So when you're 40, your equities slightly go down, and the other asset classes go up. When you're 50, it's around 40 to 60%, 60, 20 to 30%. It's very simple. Equities are the engine for the growth of your portfolio. If your portfolio bucket has high equities, your portfolio will run fast. It's like on steroids. It's like going on an airplane. But if your portfolio bucket has less equities, it's like going via a car or an auto rickshaw. There's a big difference. So having as much equities is important. If you look at the last 3 slides, the reasons why your portfolio went up or went down, the pace of your portfolio is because of the equity component, the right equity component. So you must focus on this asset allocation. If you have a lot of FDs, for example, if you have 80% FDs and 20% into equities, your 20% will go up like the markets. Maybe it will go up by 15% every year, but that's a very small portion. Your FD will grow at 5-6%. In my next video, I'll exactly show this with examples, with illustrations, the difference. I want to keep this video simple for you to understand, to start thinking about changing and making course correction. The more the equities, the faster you will grow. But equities of what type? My recommendation again is always mutual funds. Start with mutual funds. If your equity portfolio is small and your risk profile is low because you don't know, because there is fear in you, there is a lot of fear about equity markets. What you should do? Start with mutual funds. Start investing in mutual funds, some little sum, and then you can move on to direct investing, a small portion. Although I strongly recommend stay put on mutual funds. Stick to mutual funds. And you will, because why do I often tell mutual funds? I got a comment that I always recommend mutual fund because I worked in the mutual fund industry. Even those who have not worked in the mutual fund industry will tell you the same thing. Because mutual funds, you don't have to worry about where the money will go. The experts will take care. You can focus on your career, focus on your relationships, focus on your health. Leave it to the fund managers. So start with equity mutual funds and then start SIP in large cap, mid cap, small cap, depending on your risk profile, your financial goals, and your age. Start in SIPs. If you do this, 100% definitely guaranteed, you will be at the same pace at the market or even better. Yes, as you get better and better, you start making the right choices of mutual funds, direct investing, then you will actually grow at a very fast pace, just like probably like Warren Buffett or Rakesh Jhunjhunwala or some of the great investors who invest and have made a lot of wealth just by investing. But that is their job, that is their full-time profession, right? So you also can make it your full-time profession, but right now stay focused on your full-time profession and focus on these three things, and trust me, you will do well. So I hope you've now got the gist of and the concept of how to keep pace with the market. So I'm sure some of you who are watching have made mistakes, either in your asset allocation, or maybe have done trading, or have tried your hands on direct investing and have lost because of bad stock choices. But then on the other hand, I'm sure if you have made money, it is because you had SIPs, you had right asset allocation, you had more asset allocation, more money assigned to equities, and you were disciplined with an SIP in a mutual fund. So there is nothing, no great complex formulas. It's so simple. Do an SIP in a mutual fund. Stay focused on your financial goals based on your risk profile, and definitely you will grow your wealth. I want to get deeper into this, and I'm going to share with you good numbers so that you can really understand how it makes a difference, how having equities, how your net worth will keep going up because of equities by doing SIPs and by doing regular investing. But at the same time, when you have a lot of property, a lot of FDs, and even gold, how the pace of your portfolio growth will go down. So wait for that next video. Thanks for joining. If you've liked the video, give me a thumbs up. Or if you have not subscribed, I encourage you to subscribe and be a part of this channel. Thank you for joining, and I wish you success in your wealth growing journey, in your wealth building journey. Thank you. Until my next video, bye.